Welcome to the Vertical Spread Options Trading Channel. My name is Eric, and one of the questions I get a lot is when people are bearish on something, they want to know, should they consider just buying puts or buying a put spread? And I want to talk a little bit in this video about the differences and why I think you should really consider put spreads over just regular puts. And let's talk about why. So first of all, I'm going to just kind of do this example on the SPY. This is by no means a recommendation to short the SPY or anything. This is more just talking about if you have the analysis that's telling you, I want to get bearish exposure on the SPY, and there's a couple ways to do that. And we're going to compare puts and put spreads. And so first of all, we're looking at the SPY, and we have this little pattern here. And I'm just going to kind of pretend that the SPY sort of gapped up and we're trading a little bit of a bull flag here. But my analysis is telling me that I think that we pull back at some point and fill the gap, right? So here's the gap. Again, that's just hypothetical. I'm not taking this trade. We're just talking about an example here. We think in our hypothetical example that the SPY is going to pull back to about this 246, 247 area. We're going to call it 246 and a half, okay? Technically the gap's at 246.61 or something. So let's look at a couple ways we can trade this or express our theory in the market. That's the great things about options, is that you actually get to express what you think is going to happen and what or what won't happen. In this case, we think the market's going to pull back here a few points. So we're going to go back from 249.5 to about 246.5. So we think it's going to be a modest little pullback, and we want some bearish exposure. So what we're going to do is we're going to go over to the Analyze tab. And the first thing we're going to do before we jump into the options, I just want to kind of compare what it would be if we just straight up shorted the SPY. So I'm going to sell, and I'm going to come down here, and we're going to say we're going to sell 100 shares because all options are based on 100 shares of the underlying. And let's go to the risk profile. And this is something that a lot of people just haven't gotten into, and you really need to understand the risk profile. So here, I'm going to, they call them slices, which are these little lines. We're going to set a slice to basically a break-even level. So what this means is very kind of an oversimplification here, is that right now we're trading at 249.05. This is before the market. I'm doing the video, and it's very simple. We have a delta of 100 because if the S&P were to pull back $1, we would make about $100, or we would be up $100. And again, if the market were to rally up $1, we would lose about $100. So this is the price, this is how much we make, and this is sort of our profit and loss right now. So this purple line, and now I'm going to zoom over a little bit. You'll notice that it just keeps going because it's unlimited reward as well as technically it's not unlimited losses, but if the market were to go to zero, you would lose a lot of money. But just the idea that just straight shorting the stock without any options, there's really unlimited gain, but also in theory unlimited losses. Again, zero is a bottom. We don't think the S&P would ever go to zero, but it could be substantial losses. So we don't want to do that. And again, the buying power, we won't talk about that, but it's extremely high. You need a lot of capital to short 100 shares. So we're gonna skip that. So let's go ahead and go back, and instead of shorting the S&P, let's look at buying a put option. Now I'm going to go with something that's slightly in the money. We're trading for 249. We'll call it 250-ish, and I'm going to look at buying the 251 put, and we're just going to look at the front month, and we can talk in other videos about time. In theory, we're looking at this. If it pulls back for 2 weeks, I think a slightly in the money option, with 25 days left should be sufficient. So we're going to look at buying 1 October 251 put, and this costs us about $2.50. Or about $250. So let's look at this and see what this looks like on the risk diagram. So we can see it looks a lot different. Let me spread this out a little bit. And the reason why is now you have 2 lines. And the reason why you have 2 lines is that the purple line, just like in the short stock example, is the right now line. The right now line is going to continue to move to the blue line. It will eventually get sucked into the blue line. The blue line is what this option will be worth at expiration, depending on the price level that you're looking at. In our first example, the break even, and this is something that's really important, the break even here on, I'm going to make this red just so we understand. When we shorted the stock, the break even was right at the price. If the stock were to rally, we would lose money and we would make money on the way down. So if we look at the risk profile for the put option, we're going to reset the break even, and we're going to do the break even to the October expiration. And you'll notice that it kind of jumped over a little bit. So the break even for this put option just straight up is at 248.49. So let's look at that in the chart. I'm going to edit this and we're going to change it to 248.49, or I think it was 89. I'm sorry. We'll double check that. And you'll see what happened is the line actually moved down. It was 248.49. I'm sorry. Let me fix that. Edit. 248.49. Okay. So right away, we noticed that when we buy that put option, that if the market were to continue to trade sideways, we would lose money because our break even is back here. We need the market to move it to at least this level in order to make any money at expiration. Now, if your timing is impeccable and the market were to tank right away, then yes, you can make a little money. But if you do not get past this level, you're most likely you're going to lose money on the option trade. Now let's set. We're going to add a slice here just so we can kind of see this, and we're going to move it to the 246.50 level. So if at expiration, if you were holding the put option that we paid $2.50 for, and we were right in our analysis, at expiration, the put option would have a profit of about $200. Okay, that's about an 80% gain. So if we buy the put option, and let's just say that we're right in our analysis, we buy the put option here, and at expiration it moves down to this level, we're going to make about $200. Okay, so that's pretty good. That's the equivalent of about an 80% gain. Okay, so that's not too bad. The problem with this trade is if it doesn't move to this level, or it kind of meanders here around, let's say it gets to 248 and never makes it, there's a decent chance you're not going to make money, or you're going to lose money because, again, we have a time value here that's going to erode, and the option will lose money over time. So again, if we only trade, even if we get to 248, we won't make as much, but the worst case scenario here is that if it trades sideways, we actually lose money. So, for this, in order to buy the put, we really need to be right in our directional analysis. Okay, so let's get rid of that for a second, and let's change the trade to a put spread. And instead of just buying the 251, I'm going to buy the 251 put, and I'm going to sell the 249. So I'm going to sort of straddle the price with a put spread. So I'm going to right click here and I'm going to do a vertical, and let me set this. We're going to sell the 249. Okay, so the first thing you'll notice here is that by buying the 251 and selling the 249, we've just reduced our cost. Now this trade is only 82 cents, and the max gain here is the difference in the strike. So we can actually make more than the debit here. So this is the most we can lose, very similar to the put option. The most we can lose when we bought that other put is the debit we paid. So in this case, we're risking less per contract, or per spread, I should say, to put this trade on. So let's go ahead and look at the risk profile of this. And now you can see that the levels kind of change a little bit. So now we no longer have sort of an unlimited reward, and that was something that we didn't discuss when we talked about buying the single put. Had we bought the single put and the market tanked way down here, we could have made a lot more money, but that's not what our analysis says. Our analysis isn't necessarily bearish. We just think we're getting a pullback here. So again, the most we can lose now is 82 cents or $82 per spread, and you can see now that the profit is capped. So if we get down to this 248, 249 level, the most we can make, and you can look at this, is $118, which is more than what we paid. So it's over 100% gain if we get some kind of pullback. So now the break even for this particular trade is now it is up here at 250. We'll call it 250.18. So let's see what that this looks like. This is the break even. So it's going to be 250.18. Now just think about what this looks like now. Before, when we shorted the stock, the break even was right at the price. Now with the put spread, our break even actually moves up, meaning that as long as the market stays below this 250 and change level, we can actually make money. So we don't actually have to be right. Now, if we're right, we'll actually have a decent trade. But even if we're a little bit right or a little bit wrong, or the market just trades sideways, we can still be profitable or at least not lose money in this trade. And let's talk about for a second what that profit is. So now that our break even is here, if we get below the 249 level, which is the short strike we sold, we can achieve max gain at expiration, which in this case would be $118. If I bring up, I'm going to bring up the calculator real quick. And I'll move this over here. So our max gain is $118. Well, if we divide that by our price that we paid, 82 cents, we could actually make about 140% gain. Whereas previously, if our max gain was 200, which we talked about in the option example, and we divide by the price that we paid, whoops, 251, I think it was, our max gain is about 80%. So by reducing our cost, and by straddling the strike price, we were able to raise our break even so that our analysis doesn't have to be right. And we're able to have a greater percent gain if our analysis is right by reducing our costs. And so this is the main thing I wanted you to sort of take away with buying put spreads instead of straight puts. Your timing doesn't have to be as perfect. You will need to stay in the trade longer, though, if it does, you see the purple line, if the market were to tank all of a sudden, then you wouldn't realize this gain till closer to expiration, but that's okay. There's a couple nuances there. But the main thing I wanted you to take away with from this video is that we reduce our cost and we raise our break even. And thirdly, our profit percentage can be greater by simply doing a put spread that straddles the current price. So I hope that helps. Be sure to subscribe and like this video, and definitely check out the resources in the description. I got some other things for you guys there to help improve your trading. I hope that helps. You guys have a great day, and we'll see you at the next video.